Happy New Year almost. We got to say it early because we won't see you during the New Year. So we figured we wish you Happy New Year a little bit early. This is our last podcast for 2022. So we want to basically go through some 2022 takeaways as it relates to the stock market. And then we're going to talk about the outlook for the market and investing and IEA in 2023 in the latter part of this. So while Leon tells you why we chose to do this now, I'm going to do a little bit of housekeeping.
Yeah, so yes, Brent said Happy New Year, everybody, Merry Christmas and all them things like that. So it's been a hell of a year. Final podcast for the year. So we want to do just basically a recap, slight recap. I mean, we're not going to go too deep, but just kind of cover some highlights that we want to just point out to everybody that we kind of learned. Well, not learned, but that just happened this year. Some things that we learned. Well, I said some things that a lot of people learned because, as we know, a lot of people started investing. We know a lot of people started following Brent and myself in 2020 during COVID. And the only thing they saw was the stock market go straight up. And so we're gonna cover some takeaways, then we're gonna go into the kind of the new year. What we're expecting for the New Year's. Again, we have no crystal ball. We have no idea what New Year's what's gonna happen. We're gonna give our assessment based on what's happened this year, what we think may happen next year.
Yeah, and before we dive full into that, we want to thank all of you all for number one, sticking with us throughout this year. And like Leon said, many of you all joined us when the market was heading straight up. We said from the beginning, have a long-term outlook and know that this is not a normal market. However, we also said get in and enjoy it. And around November 2021, we started to put out the notice. Things are going to change. Reallocation is something that you want to look at. Hopefully, many of you all took heed. Now, this is what I want to talk about real quick before we dive full in. It's very easy to fall into a nothing else is going to happen mindset. This is the normal forever mindset when you're investing in the stock market. And we saw it happen inside the IEA with some people that were just kind of stopping by, asking questions. People thought, oh, you all are crazy. This will never end. The market will always go straight up. Have you seen my portfolio? Have you seen this? And Leon and I'm like, yeah, you still want to, you want to have diversified portfolios. You want to have an outlook that's about 2, 3, 4, 5, 10 years out. And then also you want to pick quality stocks. We did episodes on why not to go into IPOs. We did episodes talking about what SPACs really like, how empty they are. Some people listen, some people are like, oh, SPACs are the hot thing. I'm going all in. The market, it corrected a lot of our behavior. If you all have been following this, I was a proponent of single stock risk. We talked about it all the time. I had a portfolio that was like 40% Tesla. It was hurt really bad, but the lucky thing is I got rid of like more than 75% of that portfolio when the market started to change. And the other 25%, I said automatic sell on it, but that's a whole nother thing. These are strategies we were giving to you all throughout the year. And we know can't everybody listen to every single episode. That's why we have the community, people. So for those of you all who have been, following us and you're in the community, but you don't go into the community, there's a reason why we have it. It's a reason why we kept it so people could go back. Spend time there. It's a lot of good information. And I'm not saying that because it's Leon and I, but we're talking about on our podcast alone. These are people who we're getting about 651 unique downloads every month. And for the year, we're talking about 7,200 plus people downloaded our podcast. Why is that significant? Because if these people are finding value in what we're saying, more than likely it's reasonably valuable. I think it's great, but I don't want to say that because it's us.
I do too, but I ain't trying to.
Y'all, we don't want to be those people. But also too, we want to say we never went away. When the worst of it was happening, Leon and I never stopped showing up for these lives. You guys can access whatever you want. Some of you all take advantage of it. Some of you all don't. But we keep showing up. And we're telling you, even our accounts have gotten hit. We're not immune to it. But we're also telling you our outlook is much longer. We've changed the way we're investing. And as Leon's going to go into the 2023 outlook, you're going to see there's a lot changing. And also we start diversifying. For some of you all who don't know, we've probably in the between 2021 and 2022, between the group portfolio Panthers inside of IEA, we may have invested in about 7 or 9 startup companies where we took an equity position in those companies before this is pre-IPO. And then in addition to that, we've purchased international land in Ghana. We're now looking at possibly doing a land deal in Morocco, and we're looking to go back to Ghana. But this is the new thing. IEA now has an attorney. IEA now has a realtor, and we're going to be diving into the real estate market together. We're going to be doing flips. We're going to be doing rental properties. It's inside of the IEA portfolio Panthers, but we're sharing that information about loans. We talked about loans, the cost of money. These are all things that you guys really need to pay some like close attention to. Cost of money is going to be really important going into 2023 in how people run their businesses and how people invest. We're understanding that the market isn't an end-all be-all, so we're diversifying. We hope you all are too. So with that being said, Leon's going to give you some takeaways for 2022. I'm going to keep doing a little bit of housekeeping, but one part, even like in the NFT space and cryptocurrency, you going to touch on that, Leon, before I say it?
Now you go. Yeah, but go ahead. You can start off. Yeah, that could be the first thing.
Okay. So 2022, people thought, oh, you know what? We're going to get rich and retire on crypto. And we took a hard position and we said, look, even before the hard position, we said, stop looking at it like it's this miracle cure. It's just a micro tech company. And if you looked at the correlation between crypto and the tech sector, it was running in tandem. And we said from the beginning, don't treat it like it's just this miracle cure to poverty. You have to pick also quality cryptocurrencies that have a use case that are now trading, that the market won't, what's the word I'm looking for? The market isn't tentative with their products. And we've seen some wins in the space. We've seen some big losers. But we saw a lot of people who thought they were going to become millionaires, and they totally abandoned the stock market. The stock market, people, has a history. You're talking 200 plus years where you can actually track and look at what the market has done. And when you look at this cryptocurrency space, you still can't even get 5-year history of most of the stuff. And unless you truly know what you're doing inside of that space, you will get slaughtered. Or you'll waste a lot of time, you'll waste a lot of money. And that's something we hope that you all don't do if you're listening to us. And, you know, I'll let Leon take it from there because I can go really far into that.
Yeah, so to piggyback on that, I read an article, kind of a sad article, but it basically was saying how minorities really went all in on crypto. And I'm saying we because I'm a minority, we as a minority community really thought crypto was the holy grail to save the community or save the culture. What this year taught us is that cryptocurrency is nothing but another asset. It abides by the same rules, the same investing rules as every other asset: real estate, stocks, bonds, whatever. It can also go into a bubble. You know, we saw the real estate bubble in 2008, 2009. We're coming out of a bit of a real estate bubble now. We're definitely coming out of a stock market bubble that we're all experiencing right now, and a crypto bubble. Another thing about crypto is that people thought, so a lot of the crypto crashes in the past were relatively short. You know, they may have been a few months, maybe a year. I think the one in 2018 was about 8 months, and then crypto kind of started to take off again. We're going on. So the Fed started raising rates in November. The market topped in November. So we're past a year now where crypto is down about 60%. And what that shows is that crypto, again, is like no other, is the same as any other asset. It's affected by interest rates. It's affected by supply demand. It's affected by macroeconomic factors. So this notion that a lot of people had that crypto was like somehow cushioned from the general economy was ridiculous. And I kind of get why, because so the crypto community sells it as they want to abandon they want to get away from the typical financial network, right? So it's supposed to be decentralized, nobody can control it, and it can be sent around the world in an instant. what you really can't do right now with fiat currency. And so I kind of get why people were like, oh, this is separate from the regular financial system, which it is. Problem is, the same people that invest in crypto, the same people that invest in stocks, same people that invest in bonds. It's just humans, right? We all have emotions. We all act a certain way when we get scared or anxious, and we can sell, and look for other assets. So one big takeaway this year, crypto is just an asset like everything else. As Brent said, the market treats it as a highly speculative tech stock. And now we know it's quote unquote currency, but it's treated by the market as a tech stock. Very, very speculative, and in some ways unprofitable. So we know what happened with those. That's takeaway number one. Takeaway number two is diversification, right? As Brent said, inside IEA, we are diversifying big time. We're now, like you said, we now have a real estate agent representing the portfolio Panthers, and we're moving into real estate. We also bought, as Brent said, we bought a beachfront property in Ghana, and we're going to really move hard into real estate this year. I'm looking personally myself, actually, to corporate bonds, because now that interest rates are higher, corporate bonds are paying really good rates, and they're relatively safe. So diversification is key. So here's the problem, and I was guilty of this too. I don't know, Brent, you were. I think pretty much everybody was. At some point, most of our portfolios were like 80% technology, right? Like everyone, we were all deep in tech. And Brent and I talked a lot about diversification. And while we were somewhat diversified, we weren't all the way diversified, right? Because again, we're human, right? We know how diversification is supposed to work. But when you see those tech stocks going up, 20, 30%, or anywhere from 5 to 10% per day, it's hard not to go in deep. So we were in deep. We got hit too. But what this year has showed us that diversification sector and industry diversification is key. Two reasons why. This year, last year, well, really this year, and last year and this year, a lot of people most people think everything is down, right? So far this year, and the end of last year, and the energy sector is up anywhere from 30 to like 50, 60%. Energy stocks, so think like oil stocks. Also healthcare, same thing. Healthcare is up anywhere from like 30 to 80%, depending on which company you're in. So there are pockets of the market that are up and up huge, while tech is down over 30%, right? So again, Brent and I know about diversification. We admit we weren't as diversified as we should have been. We got hit too, but now we're redoubling our effort to make this statement. Diversification is key. Tech. We're not saying get out of tech, but we're saying look at healthcare, look at energy, look at retail, look at REITs, which are real estate investment trusts, which basically invest in real estate. So diversify your portfolio going into 2023, please, because this year taught us when you have either single stock risk, as Brent had with Tesla, or single industry risk, which a lot of us had with tech, it hurts bad.
Yeah, and also too, I want to talk about that. Like you talk about Tesla right now has lost like 75% of his value from the beginning.
And the thing is, it's lost that much in like he took over. Elon Musk took over Twitter in October, so
it was like 3 months.
Yeah, like 2.5, 3 months. It's down basically 70+%. Crazy.
And when you look at that, you're like, oh my gosh, like you got crushed, and that's when you're chasing that ghost. And that's what we talked about before. You can't chase the hot thing. And mostly, if you're looking at news, it's probably 20 months late for the actual market itself. The marketplace is already adjusted to that news before it hit, except for
the reason why that is because the news likes sensationalism, right? So you're not going to hear about it when you hear about it in the news. That means you hear about Tesla's run up 20% or cryptocurrency's up 100% in a week. You hear about it after the fact. So once you hear about it, don't think, now's the time to get in. No, now's the time to maybe watch it and wait for a pullback. But jumping in when you hear on the news is often a bad idea.
Magazines, it's pay to play. Oftentimes we don't know that. So you get an article about this amazing stock that's doing great. So anyway, a lot of stuff that you think in the media is like the gospel. It's the gospel that was preached 4 months ago or 2 months ago. And you're just now hearing the recording. And so with that, diversification really matters because when you create a portfolio that's based on diversification, you may have sector limits. Like maybe 10% of your portfolio, you're not going to see 10% of your portfolio in tech stocks. And so now it doesn't really matter what's going on in the market. If you follow your own parameters And if you're already at 10%, you don't have any more to allocate, right? And you have to stay diversified. And this is also why it's important to create a plan before the sensationalism happens. Create a plan before you expect the market to have a 30% run, because that plan being executed before the emotion comes takes the emotion out of the decision later on, hopefully. And that's still hopefully. But at least it's a parameter to make you say, you know what, I knew I shouldn't have done it. And, I kind of got what I deserve, right? And you go back to Tesla. I had roughly 45% of my portfolio on Tesla. However, you got to understand, I'm still up 1,200% in Tesla when I checked my account yesterday.
And you're not in it as big as you were before. You sold.
Yeah. But that the piece that I have is still because I bought it so long ago. Mm-hmm. And so when you hear me and Leon talk about these stories, understand that we have a different level of experience than some. And even though we're doing things that may seem crazy, the way we approach it is very calculated. And so this is why you should ask us questions on this platform. And I'm really stressing that we're going into 2023. And our hope is that when we do these lives and when you're listening to our podcast, we're really excited. 7,000 people found it valuable enough to download. Thank you. 651 people downloaded it last month alone. Thank you. But we're making ourselves available. Use us.
Yeah, I agree. And kind of to that point, I just want to go back to the point of diversification. Drive it home again. Because this to me, this was the biggest point of 2022 was the fact that most people watching us, listening to us, especially in our age group, were really, really, really heavy in tech. And we all, Brent, myself included, got hammered. Straight up hammered. I mean, my account is down. At the worst this year, it was down close to 45%. I've regained some, so I think I'm down like I'm still down. I'm still like 30 some odd percent
compared to last year. I was down like 57.
Yeah, because you had a little more single stock risk. And you were bigger. You were a lot bigger in Tesla than I was. But yeah, I mean, we got hit. Like we got hit, and we are still hit. But we have a plan on how to. And like I said, I've recovered about 15% through my diversification. Sold a lot of tech beginning of this year. Sold a lot of tech. I'm not. So my biggest positions right now, my biggest sectors right now, which is great. Yo, I look at my portfolio and I'm just like, yo, this is like doesn't even feel like me. Two biggest sectors are consumer staples. So think things like Campbell's soup and like grocery stores and healthcare. Two of my biggest positions, two of my biggest sector positions, consumer staples and healthcare. Last year, I never would have thought about that because the growth was in tech. But now this year, I'm being a lot more defensive because we know what happened. And going to 2023, I'm going to stay defensive until the market tells me that we're kind of out of this situation. So,
and Leon, real quick, let me jump in. If you all have been listening to our hot seat, we have found some amazing stocks that Leon and I have invested in. So I hope if you're a member, you go back and listen to some of these hot seats. We found stocks that have returned this year in 2022, 70% rate of return.
Along with 9%,
10% dividend.
Yeah, on top of that, yeah. Mm-hmm.
Like it was I think it was a 7.46% dividend.
Yeah, so
in that one stock in particular. Mm. And then we found, we're going back like to the summertime. We were already starting to analyze portfolios. We found some companies that were paying dividends consistently over 9%. Mm-hmm. And when Leon talks about going into corporate bonds, some of you all might be like, "Oh, I heard they're junk bonds," because that's a term they use in the industry for corporate bonds. It's not a direct correlation to the quality of the actual bonds.
Right.
It's a name Wall Street gave years and years ago because they were considered junk when compared to the actual security itself when Wall Street was on a climb. And that was a name given very early in like the creation of corporate bonds. But even looking at the corporate bonds, let me tell you about the benefit of those over some of these like Series E, HH. When you're looking at these bonds, most of them in Treasury bills. So the T-bills, they have limits on how much you can invest into any particular bill. Many of these corporate bonds do not have the same limitations. So for those people who have a portfolio that's like 50,000, 100,000, 4-6 million, you can actually go to a corporate bond market and invest a large majority of your money into some of these bonds where you can't do that in the Series H, I bonds. And so you're like, oh, but it's the government. guaranteed money for the most part. Yeah, but if you can only put a max of 50,000 in or 10,000 in some cases, how much can you put away? So you really need to understand the diversification of even the bond markets. Just because it's a bond market, like what is your maturity date? How long does it take? Does it have coupons associated? Are there no coupons? What is a coupon? What's the taxation on that? Because then also you got to know what the tax equivalent yield is. And so we looking at, something that has a tax free side or a taxable side, they may not be apples to apples when you think about how much you're saving in taxes.
And also these bonds are paying. I mean, like for instance, I looked up forgot the name of the company, but I was looking up one the other day. And it was paying 9.5%. This is I think it was U-Haul or AutoZone or something, some company, but it was paying, their bonds were paying like on their, it was like a 5-year bond, a 3 to 5 year bond, that and it's paying that per year. So it was paying like 8 or 9%. And so you think about that, right? So you go drop, like Brent said, $10, $20, $30,000 into this corporate bond. Again, we're talking about companies. We're not talking about companies that are speculative and like these tech stocks. We're talking about overline companies like I said, like AutoZone, something like that.
AutoZone was killing it. Remember we looked at that stock?
I think AutoZone is up like 10, 20% for the year, the stock. So you think about it, you have the stock that's up 10, 20% on the year, and then you have the bond that paid, say, another 8, 9, 10%. That's anywhere from 25, 30% return just on the stock and bond alone. So anyway, so just so the point I'm making is that going to 2023, the stock market will always be Brent and I's number one place, but we've always known, but now we're taking it a lot more seriously about diversification within the stock market, and then assets outside the stock market, like real estate, like land, things like that. Okay, so let's move on to 2023. So what's going to happen in 2023? We have no idea. We have absolutely no idea.
That's not true.
No.
We have an idea.
We have okay, yes, we have an idea, but we have no idea what's actually going to happen.
Yeah.
So here is my idea of what's going to happen. Well, so again, go down the road. Nobody wants to hear because we talking about it all year. But my perspective is I have no idea what's going to happen. Typically, I would have an opinion on next year. I have an opinion on everything. I would typically have an opinion on next year in the stock market, but I do not have an opinion on the stock market next year because of what the Federal Reserve is doing. Until we know until we know when they're going to stop raising rates, the market's going to act like they're going to raise rates into perpetuity. And the market's so what we got in 2023, I'm anticipating will happen the first half of the year. So it'll be choppy, up and down, go nowhere. Just a terrible, to be honest, it's probably a terrible market like this year. Now, based on the Fed's terminal rate, which they told us would be around 5%, some people think they won't get there because the economy will be so bad that they'll have to stop raising rates. But the prevailing notions that the Fed will stop rate, or they'll pause, call it a pause. They'll pause raising rates roughly between March and May of next year. Once the Fed announces, hey, we've done our job, we've got inflation, on the ropes, not saying it's done, but we're going to now, quote unquote, pause the rate hikes and let the high rates, spread throughout the economy more than they have. Once they do that, the market will rally. Now, I'm not going to say it's going to rally hard. It's going to rally because, remember, even though they're going to pause rates, they're still going to keep rates high, right? So it's what they're calling higher for longer. So they're going to keep rates elevated. They're saying at least for a year. Again, we don't know. This is what they're saying, but we don't know what's going to happen. But the market is not a fan of high rates because the market wants free money. But the market will be ecstatic that they're going to pause at a certain level, and then because what can happen there is now companies can now start planning for the future. They know how much the cost of money is going to cost them. Financial analysts can start modeling out what earnings are going to look like. Like things will free up. Things will loosen in the market once the Fed pauses rates. And again, I think that'll happen between March and May of next year. But until that point, no idea. Now, if that does happen, second half of the year, I see a rally. Now, what that rally is, I don't know. We're definitely not going back to all-time highs. I don't believe. But I do think we'll get some sort of maybe 5, anywhere from maybe 3 to 5% second half of the year, maybe more. But I think we will get some sort of rally. Other side of that is so the Fed will do that if inflation comes down. If inflation does not come down to their liking, man, 2023 will be a repeat of 2022 because they will raise rates well above 5%, maybe close to 6%. The market will hate that. The market will drop probably another 10%, and we'll just be in this malaise for the next year. So, but my anticipation
don't forget, next year we're going to it's the year before an election.
That too, right. And there's certain seasonalities with that. Like the market typically acts a certain way the year before an election. So so if the worst case scenario happens where inflation does not come down to their liking, and they continue to raise rates, I mean, just to be real, it's going to be a terrible market again next year. I don't anticipate that happening because inflation is already showing signs of coming down. The last two CPI reports dropped dramatically. The Fed acknowledged that. They were like, "Good, we're seeing positive results of what we're doing." They want to see more, but they acknowledge that things are happening. So, I think by mid-year they're going to pause. The market will love that, and we'll get some sort of rally into the end of the year. So that's what I'm anticipating for 2023. I'm hoping, praying that this inflation thing finally goes away, and we can get back to normalcy, get the Fed out of our like minds and mouths for 2023. So that's my spiel for 2023.
Yeah, and for all of you all who are going to the end of the year, you want to start taking account into, for you cryptocurrency investors, where is your money? What platform is it on? Check the platforms. Some of these platforms are claiming Chapter 11 bankruptcy, and that means they're taking your money with them. So if you got nothing from this and you're a cryptocurrency investor, that's very important. Also, look at what the actual cryptocurrencies that you have. Some of those cryptocurrencies have went bye-bye. And if you're not checking your account, you may not even realize that the account is zeroed out. You need to pay attention to that. Some of you all have credit cards through cryptocurrency. You have put certain amount of monies in pools. If you've been pooling your money, check those because, again, some of those pools have changed their terms. So you might actually now be getting better terms in the corporate bond market or even the government bond market. But if you don't check your accounts, you just won't know. And for those of you all who just buried your head in the sand and say, you know what, wake me up later, you need to be reallocating your account. The market will not reemerge the same market as you saw before. It will not. Speed at which it accelerates will not be the same as it was before. It's going to be slower. And you're going to have to be a person picking stocks, not just hoping that you can have a blanket of everything that's amazing by getting an ETF. You have to look at what you're investing in. You have to understand the financials, the strength of the company. You never hear me talk about that. That's going to be more important now than ever. Like how financially secure are these companies? Because one thing happens on U.S. soil that causes a major disruption. The first thing to take a hit is going to be speculative stocks,
as we've seen this year.
Yeah,
and just real quick on what you were saying about cryptocurrency. So, read an article today or yesterday that some of you may have money in this particular exchange. Kraken is, I think it's like it's like the second or third largest exchange in the U.S. Now it doesn't really affect us, but they're shutting down. They're closing their exchange in Japan. So they also have an exchange in Japan where they're shutting that down. The reason I bring that up is because this is happening all over the world for different exchanges. They're shutting down. So like Brent said, some of them are going out of business. Some of them are shutting down. Shutting down. I guess non-profitable wings. So this is happening in real time. So yeah, like Brent said, you definitely want to check out where your cryptocurrency is. And we've all, I'm sure, have heard about the FTX collapse. $8 billion is just gone. People just $8 billion worth of customer deposits are just gone for now. We're hoping everyone's hoping they'll find it. But again, it comes back to know where your money is, know how much you have deposited there, and just be aware of that because if you don't know how much money you have deposited or where your money is, and one of these things collapses or goes out of business, you want to have some sort of recourse. How much money you had there and which exchange it was on. So definitely take an inventory of where your money is in the crypto market. Crypto has, like I said, it's shown it's just another asset. It's nothing special. It goes down to when rates rise and the economy's bad. So we got to get out of this notion that crypto can save us. No, it's just another asset. It's another speculative asset that should be part of everyone's portfolio. Small portion, but should be part of everyone's portfolio. But it's not a holy grail like everyone had anticipated.
Yep, and we're going much further than what we anticipated, but this has to be said too. Many of you all thought that, oh, well, I have this IUL index universal life insurance, and then some of you all had variable universal life insurance. And you thought, oh, I'm fantastic. The market is going to keep being gangbusters, and this will be great forever. We warned all of you all. These things are directly correlated to the market performance, and because of that, some of these policies are imploding really. And you have to look at the mortality expense inside of these. When you look at the mortality expense, you also have to compare it to your life expectancy rates. Like, these are things people weren't doing. Those costs are offset in the assumption that the market will continue to do well. And depending on how you structure your policies, these policies are imploding because the thought was you're going to continue to see a 20, 15, 10% rate of return into perpetuity. This is why oftentimes we talk about term life insurance. It gives you the minimum cost, exactly what you need, but then this is it. I'm going to go, whole life insurance, traditional whole life insurance. Last week, I guaranteed that one of the individuals that we know inside of IEA's daughter will be a millionaire at her retirement age. It is contractually written into her life insurance policy. And I don't mean the face amount of the policy. How much cash she has in the policy will make her a millionaire at age 65, guaranteed, unless the company goes belly up. Which, if anybody knows anything about history of finance, when Wall Street was in trouble, when the governments were in trouble, they went to institutional investors and they went to life insurance companies, banks, and then uber wealthy individuals. And normally, uber wealthy individuals they went to have funds of their own. Mm-hmm. These institutions don't really go under. Most of their holdings are in bonds because they have so much money they don't need to be in the market, which gives them the ability to actually give you guaranteed. So for some of you all out there thinking, well, there's nothing else, internal rates of return on some whole life policies were as high as 12% in the down market if you structured your life insurance correctly. So for those of you all who are thinking like, oh, my daughters, they have investment accounts. But you know what? My daughters also have whole life insurance policies that are guaranteeing them to do well in the future, regardless of what happens. So when this market stuff is happening, that's another form of diversification. Mm-hmm. So when everybody's like, oh, the sky is falling, it is over here, but it's sunny and beach looks amazing over there. So you have to understand that when there's rain here, there is sunshine somewhere else. Look at that when you're thinking about diversifying your portfolio, because it's not just bonds, it's not just stocks, it's not just real estate. You have investing into other businesses. You have cryptocurrency still here. NFTs are still here. You just have to do it the right way. And then you also have
life insurance. You just talking about is will always be here. Yeah.
Yeah. I mean, this is one of the oldest things ever. And so it's like, there's money to be made out there. If you're not having conversations like the ones we have inside of IEA, if you're not asking us questions about what else are you doing, we may forget to tell you. Like, it's at least, Leon, from between you and I, this year alone, in various ways, we've guaranteed to make millionaires over the next 10, 15 years. Like, people who will be guaranteed to be millionaires. And it's not all through the market. We've made millionaires already in the market. But you know what? They're feeling pain right now, just like everybody else. But they're still millionaires. And so There's a different kind of pain when you're a millionaire than it is when you're looking at your life savings go down the toilet.
And I just want to make one last point on long-term investing. So Brent made the point earlier. So we all know, well, now we all know. So people that know or don't know, Tesla right now is down 73% for the year. 73% for the year. And most of that just happened in the last 2 months. Brent has been in Tesla for how many years?
At least 10.
At least 10 years, right? So Tesla's down 73% this year. And Brent's been in Tesla for at least 10 years. And Brent, you say you're up in Tesla since you've been in it.
1,190
1,000. So
1,192%.
So let's say 1,200%.
Yeah.
So Brent has a return in Tesla of 1,200% over a 10-year period, whereas people that are in Tesla just this year are either down 73%, or if they joined last year, depending when they got in, they may be up like 2 or 3% now. And this is what we come back to what we say about long-term investing. Investing is not a short-term game. 1 month, 3 month, 1 year, 3 year, not long enough. We always say 3 years minimum, but really 5 to 10 years what you should be looking at. So just want to make that last point. Going 2023, diversification, one major point that I'm gonna do better at this year. Because I wasn't that great in 2022, and two, yep, you weren't either. And two, to remember this is a long-term game. We're in this for minimum 3 years, but really think 5, 10 years and beyond into 2023.
Yep. So, with that being said, we really, again, we thank you for all of our new members. Just in the last week, we've had 2 new Portfolio Panther members. That means they'll be actually investing with us and growing with the company. These are great strides, because as we move into real estate, we're never going to forget stock. Like, that's one of the things we feel like minorities especially aren't taking advantage of. But right now is what they call a dip. And so a lot of these stocks that are quality stocks are on sale. Mm-hmm. And I absolutely promise you all, in 5 to 6 years, some people will be like, oh, I should have got back in, I forgot. Or I didn't think it was real. Some of those people are going to be like, oh, I'm glad I stayed in, because now I'm up again. And then there's going to be those people like, I didn't get in. I don't want to get in now. And they're going to stay out the market because they feel like they missed the boat, which they probably would not have. But they're going to feel like that. And it's going to be 5 years later. And they're going to be 5 years closer to retirement, which means they have 5 less years to invest. And they're going to be trying to figure out what to do. And right here, right now, it's the end of 2022. We are telling you there are a lot of quality stocks that are still on sale.
Yeah. Yo, real quick, Apple is now down 20% on the year. Apple's worth, it was worth $1.9 trillion at one point. I think it's still a little low.
Tesla was one of them.
Tesla went from $1 trillion a couple months ago to now down around 400 million. So it's lost $600-700 million in value in the last couple months. So
billion.
But for Apple, but what this is showing us is that, again, the market does go down, right? 2020, 2021, a lot of people thought this thing will go to the moon forever. This does happen. Bear markets are part of the market mechanics. It does happen. This one is Fed induced, which means the economy. This isn't something like 2000. This isn't something like 2008 or 2000 or the dot-com bust where it was more economic based. This is actually the Federal Reserve trying to cause. They will never say it. But the Fed is trying to cause a mild recession to kill demand, to bring down inflation.
But you also have the semiconductor shortage. You got war in Ukraine.
Yes.
And then you have the cryptocurrency, which is a completely new asset class, which caused a lot of people to leave the market and dive in thinking it was going to save them from poverty. Didn't happen. And then you have what's going to happen in the future. It's going to be the effects of the real estate market with the rising interest rates. That the market still has not truly, the real estate market, for anybody who's in real estate, the real estate market still has not truly caught up with the increase in the cost of money. It's still trying to catch up to
the process. Yeah. So just all right. Finally, last point. What we're going through right now, just last cap, we're going through a period right now of a resetting, because what happened during COVID was totally, well, actually, okay. We're going through a reset for 2 things. In 2008, when the Fed cut rates to 0, they never raised them back, right? So we've had free money essentially since 2008 through essentially now. So that's one thing. Money was free. 2, then the government gave us about $2 trillion.
Yeah, stimulus.
So $2 trillion in stimulus checks during COVID. On top of that, we then saved, because remember, people weren't going to work, they were going out to eat. They then saved from their jobs, their paychecks, another $2 trillion. So the reason we have all this inflation is because right now $4 trillion with a T, is flooding the economy, trying to buy goods and services. Everyone wants to get out and everyone wants to party. So what's happening right now is we're getting a reset back to like 2009, and really back to 2007 when interest rates were around what they are now, close to 5%. Yeah. So we're going through a really, really terrible reset in the economy, but it has to happen.
Necessary time.
Necessary. I'm saying it has to happen, and once it's done, we'll be fine. But it does hurt. I mean, Brent, we're right there in it. It is painful, but on the other side of it, it's gonna be beautiful. It's gonna be a beautiful thing, but we just gotta get through it.
Yep. So for everybody who's with us again, we appreciate you all. We hope you have an amazing and very safe New Year's. We look forward to seeing you in 2023. Again, these lives will be occurring every other week, not every week. So it's gonna be every other week. Set an alarm. Do what you got to do to remember that these come on, and write down questions during the week that you may have for us. And we can't answer everything. We'll answer as much as we can. And we've shown up in the worst of it. So if you all know, hopefully, if you haven't thought anything about us, is that we're not going to run when things get bad. We're going to be here. So
old hat. We've been here before.
Yeah, we've been through this. So thank you. We really appreciate all of you all. To our new members, welcome. To our new Panthers, we look forward to making some money together. This is going to be a really good year, and we're expanding. So as we go through our real estate adventures, we will be posting some of the houses that we're buying, some of the renovations we're going to be showing you. When we make good moves and when we make bad moves, we're going to be showing you all. So visit our YouTube channel. I look forward to showing you. If you all are interested in what we're doing, let us know. But the bottom line is have a long-term outlook. We're all going through it. But again, don't think a holding strategy is just going to save you from everything. Sometimes you need to reallocate. Mm-hmm. And if you need help with it, contact Leon or I, and we'll do what we can.
And final last point is we will be back starting in January in our first podcast of next year. We'll get back to our the stock picks, our two picks for the week. We're not going to do one this week, just end of the year. Didn't do any research, but starting next year, first podcast of the year, we'll get back to doing our stock picks during the podcast.
Yep. When we'll let you know, I'll know if that's going to be on the 4th of January or if it's going to be the following week. But we'll post it well in advance.
Yeah, maybe traveling during that. So
yep. Have a good day, everybody, and happy